Today, after the Ides of March, the Property Imperative Weekly for the 21st of March 2020. Hello again, it's Martin North from Digital Finance Analytics, with the latest post covering finance and property news with a distinctively Australian flavour. As we've been issuing posts each day this last few days, we're not going to go through a complete summary of all the week's events as normal. We're just going to update you on some of the incremental things that came out overnight, and also talk a little bit about some of the things that we expect to see more about ahead. And the first thing I wanted to talk about was more coordinated central bank action. There was a release that was put out by a number of the central banks along these lines. The Bank of Canada, the Bank of England, the Bank of Japan, the European Central Bank, the Federal Reserve and the Swiss National Bank are today announcing a coordinated action to further enhance the provision of liquidity via the standing US dollar liquidity swap line arrangements. To improve the swap line's effectiveness in providing US dollar funding, these central banks have agreed to increase the frequency of 7-day maturity operations from weekly to daily. These daily operations will commence on Monday, March the 23rd, 2020, and will continue at least through to the end of April. The central banks will also continue to hold weekly 84-day maturity operations. The swap lines amongst those central banks are available standing facilities and serve as an important liquidity backstop to ease strains in global funding markets, thereby helping to mitigate the effects of such strains on the supply of credit to households and businesses both domestically and abroad. Now, the thing about that, of course, as we've discussed, these swap lines are essentially ways of providing US dollar liquidity, and it has two functions. One is to meet needs in each of those major economies for US dollars, and secondly, it helps to control the US dollar exchange rate, which of course was shooting away. So the fact that they are now going to do this more frequently may signal that we would expect to see the US dollar a little weaker ahead, but we'll see. Nevertheless, I think it's a very significant movement, and once again, it's another step towards more central bank manipulation of the global financial system. Now, in that vein, we also got more from the Fed. The Fed supports liquidity of US state and municipal money markets. The Federal Reserve Board on Friday expanded its program of support for the flow of credit to the economy by taking steps to enhance the liquidity and functioning of crucial state and municipal money markets. Through the Money Market Mutual Fund Liquidity Facility, or MMLF, the Federal Reserve Bank of Boston will now be able to make loans available to eligible financial institutions secured by certain high-quality assets purchased from single state and other tax-exempt municipal money market mutual funds. All US depository institutions, US bank holding companies, parent companies incorporated in the United States, or their US broker-dealer subsidiaries, or US branches and agencies of foreign banks are eligible to borrow from the facility, and there are a range of collaterals that can be pledged from US Treasuries, various sorts of securities, asset-backed commercial paper, unsecured commercial paper, municipal short-term debt, and the facility may even receive other types of repurchase agreements too, so it's quite broad. And advances made under the facility that are secured by US municipal short-term debt will be made at a rate equal to the primary credit rate in effect at the Reserve Bank that is offered to depository institutions at the time of the advance, plus 25 basis points. So this is yet another liquidity play and helping to support yet another sector of the marketplace. And I will just remind you, as I discussed with John Adams in a separate show on In the Interest of the People, that in the last little while, the Federal Reserve has increased its repo operations overall by more than $1 trillion US dollars. And the chart that John produced highlights the fact that the repo exercise started back in last September. So this is not just a direct response to the current medical emergency. this is a much more significant and longer-term issue relating to the structural issues within the financial system. Meantime, there was a pretty stunning and frankly unprecedented announcement from the UK. The UK Treasury said that it has undertaken unprecedented actions to support households and businesses. It'll be interesting, of course, to see what the Australian government comes out with when they announce theirs, because the UK is providing wages support, rental support, and more support for the small business sector. And Capital Economics said that it expected the unemployment rate in the UK to rise from just under 4% to about 6% due to the current crisis. However, without this latest round of interventions, that rate would have risen to the financial crisis level of 8%. So the government announced a new job retention scheme where any employer in the country, small or large, charitable or non-profit, would be eligible for the scheme, but it does not cover those on 0 hours contracts or who are self-employed. So in other words, you must be employed by somebody else to get access to this support. And the support is pretty amazing. The government grants will cover 80% of the salary of retained workers up to a total of £2,500 a month. And that's above the median income level in the UK. Employers can top up salaries further if they choose to. And employers will be able to contact the UK tax authorities for a grant to cover most of the wages of people who are not working but are furloughed and kept on payroll rather than being laid off. And furloughed is one of those funny words just been rolled out. What it basically means is rather than dismissing somebody, you keep them on standby until things improve. And the UK strategy is to try and have the workforce ready to go at the point when the medical emergency abates. The scheme will cover the cost of wages backdated to the 1st of March and will be open initially for at least 3 months, and it could be extended for longer if necessary. There are no limits on the amount of funding available for the scheme. And in addition, he announced that the business interruption loan scheme that was announced earlier will now be interest-free for 12 months, not 6 months. So that's more support for businesses too. And a further cash flow support will also be provided through the tax system for businesses, deferring the next quarter of VAT, in other words GST payments. And they calculate that that's a direct injection of around £30 billion of cash to employers, which is equivalent to 1.5% of GDP. And they'll be launching in the coming days, they say, a major national advertising campaign to communicate the available support for businesses and people. And they also went on to say that to strengthen the safety net, the universal credit standard allowance for the next 12 months will be lifted by £1,000 a year, as well as increasing the working tax credit basic element by the same amount. Together, these measures will benefit around 4 million of the UK's most vulnerable households. And they said that as a result, every self-employed person can now access in full universal credit at a rate equivalent to statutory sick pay for employees. And this takes to £7 billion the extra support being offered through the welfare system to strengthen the safety net and to protect people's incomes. And of course, they've already said that UK homeowners will get a 3-month mortgage holiday if they need it. And they also announced nearly £1 billion of support for renters by increasing the generosity of housing benefit and universal credit so that the local housing allowance will cover up to at least 30% of market rents. They called these actions an unprecedented economic intervention to support the jobs and incomes of the British people. And they also went on to say that further measures will be announced next week to ensure that larger and medium-sized companies can also access the credit they need. And I just want to pause here and say this is a remarkable intervention from a Conservative government, essentially providing direct government support, funded of course by more borrowing, to businesses and households and even those who are self-employed to an extent. But nevertheless, it's been criticised in the UK because the support for gig economy workers and casual workers, as well as the self-employed, is still significantly lower than those who are employed. And it's also worth noting that the scheme for the employed sector of the community only works for those who've been completely out of work. So whereas perhaps a firm of 10 might have decided to give all 10 employees some work, but not full-time work, this will skew them rather to giving full-time work for, say, 5 and laying off 5. So there's an interesting trade-off going on here, which I'm not sure has been fully understood yet. But once again, it underscores how the UK is reacting. And of course, they have now closed pubs and clubs and entertainment venues and essentially are dialing back mobility to try and tackle the emergency. Relative to Australia, our rules here are much more loose compared to what the UK has done in the last few days. And I wonder whether that's going to be a harbinger of what happens here. Now, just on the property market, I attended 3 auctions today, of course, being socially sensitive and distanced sufficiently. All 3 were in the local area here. They were houses and, frankly, quite nice properties, but not one person turned up for any of the auctions, and so the auctioneers went away with their tails between their legs. And to underscore it again, these were premium properties, so I would have thought a few weeks ago they would have sold. And Domain has come out with their preliminary results for today, and the numbers appear to be down a bit, despite the media hype I noted in the AFR, which was saying that there had been frenzied buying parallel to toilet paper. Just remember that some of those media outlets are also property company outlets too, so there may be some correlation. And there were actually more properties listed for auction this week than last week, although a lower preliminary rate so far. They reported that in Sydney there were 776 auctions listed. They had a report on 495 with 388 sold, 107 withdrawn, and another 107 passed in. Weird coincidence or an error? I'm not sure. That is what Domain is telling us. And that gives a Domain clearance of 64% compared with last week's final rate of 67%. The 64% will go lower, of course. And I will highlight again that, of course, the way they calculate is very weird because essentially they calculate on the reported number rather than the listed number. If you take the listed number, it's a lot lower. In Melbourne, there were 1,184 auctions listed. They reported 827 with 537 sold, 46 withdrawn, and 290 passed in to give a Domain clearance of 62%, compared with last week's final of 65.2. Canberra listed 56 auctions, reported 38 and sold 26, with 2 withdrawn and 12 passed in, giving a Domain clearance of 65%. And Brisbane listed 95 auctions, reported 37 and sold 18, with 9 withdrawn and 19 passed in, giving a Domain clearance of 39%. And Adelaide listed 47 auctions, reported 28, with 19 sold, 1 withdrawn and 9 passed in to give a Domain clearance of 66%. So I'm calling this a bit of a watershed insofar that going ahead, I expect social distancing to really bite, and therefore the number of properties that are sold will drop considerably. And of course, in these Domain results, we don't know how many of those properties were sold today versus in the prior period. There is always some confusion. So I'm not sure this tells us very much at all. I've already noticed, though, that a number of the media outlets are trumpeting that everything is fine in the property sector. I wish it were true, but I have to say that I think property prices will continue to slide from here. And I've had a number of people approach me basically saying, should I buy or should I wait? Now, I don't give specific advice, but what I am saying is that given everything that I'm seeing at the moment, I think prices are more likely to go down rather than up. And I discussed this earlier in the week in one of my other posts. I'll put a link down below if you want more details. So now let's just quickly turn to the international markets. I already covered the local markets in my post yesterday. Again, I'll put a link below to that. But the Dow Jones overnight was down 4.55% to 19,173. The S&P 500 index was down 4.34% to 2,304. The US Financials Index was down 3.27% to 312.65. And Goldman Sachs was down 7.41% to 138.41. The Volatility Index dropped a little, down 8.28% to 66.04. And the Nasdaq was down 3.79% to 6,879. I'll just look at a few of the major shares. Google, Alphabet, was down 3.91% to 1,068. Amazon was down 1.85% to 1,846. And Apple was down 6.35% to 229.24. You can see how far those stocks have fallen. Boeing, who just received a $50 billion support package from the federal government in the US, fell 2.76% to 95.01. And GE is up 0.62% to 652. And you can see how far they've come since 2016, when they were sitting at 32.45. Now, in terms of the bond yields, the 30-year bond was down 5.69% to 1.473. The US 10-year bond was down 5.62% to 0.885. And the 3-month was up 27.11% to 0.038. It's a very low number there. The dollar index was down 0.79% to 101.95, and you can see there how strong the US dollar has been, which is one reason why the Aussie dollar is relatively weak at the moment. In the UK, the FTSE was up 0.76% to 5,190, and the pound US dollar was up 1.37% to 1.643. Deutsche Bank dropped 0.83% to 560, and the US dollar yuan was down 0.14% to 7.0960. And the Shanghai Composite was up 1.61% to 2,745. The German 10-year bond was down 0.15% to minus 0.326. And looking at gold, that was up 1.48% to 1485.6. So gold is still way off its highs. Silver was up 4.38%, but is sitting at 12.34. Copper is down 1.53% to 2.19. And crude oil futures, the WTI index, was down 8.68% to 22.43. And incidentally, the US is sending a delegation to Saudi Arabia to try and discuss the current oil price situation, because many US companies are now finding that the oil price means that their oil shale operations are out the money considerably. And the Bitcoin price was down 7.39% to 6,117. And frankly, no idea what Bitcoin is worth, because of course it's highly volatile at the best of times and even more so these days. So finally, looking at the S&P 500 Futures, that is at the moment down 5.07% to 2,437, signalling more falls on Monday. And the Nasdaq Futures is down 4.87% to 7,417. And part of that may well be because Congress in the US has so far been unable to agree a package of support for the US economy. It was meant to be a large package, including potentially checks direct to households and or businesses, but they're still negotiating even now, which suggests that that support package may be delayed. And just to close out today's market information, the ASX 200 futures is down 4.9% to 4,709, which suggests that there will be further falls as we go into the start of next week. So in summary, all of the leading indicators so far are suggesting that whilst the central bank liquidity interventions are helping to support the financial plumbing, the vagaries of where we are with regard to the medical crisis that we face, and the unknown unknowns about how long this is going to run for and how deep the recessions, or dare I say depressions, will be, makes it very hard to value any stocks and shares at the moment. And frankly, whilst there are some people day trading and taking positions and hoping to make money in the volatility, most people, I think, would prefer just to step back and let this play out in the days and weeks ahead until things settle a bit. And I suspect you could also argue the same for the property market in Australia too, because I think it's unlikely that people are going to want to commit given the level of uncertainty about jobs, property prices, and all those other factors. So we are continuing to live through very uncertain times, and we'll be watching this on a daily basis. And just to explain the title of this video, the Ides of March is actually the 15th of March, which was last Sunday. So since then, we've been tracking the high levels of volatility, the massive interventions from central banks around the world, and all stops are being pulled, all kitchen sinks are being thrown, and frankly, everybody is trying to keep the ship afloat. The question is, do we have enough ammunition? And how long are we going to be paddling for? I just have no idea. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.